Mr. Fussell. This is Business 101. Today we're going to be going over the economy and business. This is for the GCSE level for the AQA exam board. So, the economy and business. The economic climate has a big impact on businesses. The level of consumer spending affects prices, investment decisions, and the number of workers that businesses employ. So, what is the impact of the economic climate on business? So, the economy includes all activities in a country concerned with the manufacturing, distribution, and use of goods and services. The economic climate has a big impact on businesses, okay? The level of consumer spending affects prices, investment decisions, and the number of workers that businesses employ. The economic climate affects businesses in 6 main ways. Number 1, unemployment. Number 2, changing levels of consumer income. Number 3, changes in interest rates. Number 4, inflation. Number 5, government taxation. And number 6, changes in exchange rates. Unemployment. If somebody does not have a job, this does not necessarily mean that they are unemployed. Some people choose not to work, either because they are wealthy or because they have family to look after. Others may not be able to work because they are ill. People who are unemployed are those who are actively seeking employment but are unable to find work. So, how do people become unemployed? Some reasons people become unemployed are that they are made redundant. So this is where people whose last job ended because there was no more work available or no further need for their role at the company. They were dismissed. People whose last job ended because they broke their contract of employment, e.g. by engaging in misconduct. Or a school, college, or university leaver. So people who have just completed full-time education and are seeking work for the first time. What is the impact of unemployment? So, unemployment means that an economy is not making full use of the workers that are available. The economy will not grow as quickly as it could, and it may start to slow down. This downturn in economic activity will directly affect businesses. Higher unemployment will mean that many households will have less income. For many businesses, this will result in lower sales as people spend less money. However, the demand for some products and services will increase when unemployment is higher. This is because consumers swap to cheaper alternatives. Such goods and services are often supermarkets' own brand products and are sometimes thought of as lesser quality goods. Businesses that provide them may benefit from higher levels of unemployment. Businesses that benefit where there is an increase in unemployment will also have more people to choose from if they need more staff. Businesses looking to recruit people may also be able to offer lower pay and still attract new staff, although they cannot offer less than the national minimum wage. Changing levels of consumer income. Income is money that is received either from work or from investment. The amount of income someone earns will influence how much they spend. So how does increases in consumer income affect businesses? Let's get into that. As consumers' incomes increase, people have more money to spend. This means that demand for many goods and services will increase as consumers look to spend the extra money. They might buy upgraded versions of products they already have, e.g. a new car or take an expensive holiday. Businesses will expect to sell more of these luxury goods and services, so they will produce more, perhaps employing more staff in the process. How reductions in consumer income affect businesses. So, if consumers' incomes fall, people will have less money to spend. They will buy fewer goods and services as they will make do with what they already have. When they do spend money, they may buy cheaper alternatives, such as supermarket, own brand products, or second-hand items. Businesses will expect to sell less when this happens, so they will plan to reduce the amount they produce, possibly making staff redundant. And now remember, not all businesses are affected in the same way. So, not all businesses will see demand for their products change in this way. The effect of a change in consumer income will depend on what a business sells. For example, pound shops that sell products at discounted prices often see sales increase when consumer incomes fall. Change in interest rates. So the interest rate represents the cost of borrowing money or the amount a saver receives in interest. Usually stated as a percentage, the rate reflects how much is earned or paid in interest. For example, an interest rate of 4% would require £4 to be paid for every £100 borrowed. Alternatively, a saver would receive £4 for every £100 they invested. The impact of a change in interest rates. So changes in interest rates affect both savers and borrowers. So let's go into how that works. First off, we're going to do what an increase in interest rates means for savers and borrowers. So for savers, they will receive more interest on their savings. This will encourage them to spend less so that they can save more. And as for borrowers, this will have to pay more back for the money that is borrowed. So this will discourage them from borrowing. And then the reverse happens when interest rates decrease. So for savers, they will receive less interest on their savings. This will discourage them from saving, so they may spend their money instead. And as for borrowers, this will increase the amount of money that is borrowed or wanted to borrow because you have to pay a lower amount back than if you were borrowing during high interest rates. So how interest affects businesses and how to calculate it. Many businesses borrow money, so they are affected by any change in interest rates in the same way as individuals are. They are also affected by changes in consumer spending. That occurs as a result of changes in interest rates. Businesses that sell expensive luxury goods, such as new cars, are the most likely to be affected by changes in interest rates. When consumers have less to spend, they are more likely to need to finance these types of goods through borrowing. As a result, they may sacrifice these purchases completely or replace them with cheaper alternatives. So, for example, a second-hand car rather than a brand new one. So, interest is calculated by total repayment minus borrowed amount equals interest, okay? Interest rate is total interest divided by borrowed amount times 100. So, for example, £20 total interest divided by £100 borrowed amount times 100 equals a 20% rate of interest. Now let's talk inflation. Inflation refers to a general and sustained increase in prices over time. It is measured using an index, e.g. the Consumer Price Index, also known as CPI. This tracks how the price of a typical basket of items changes over time. The rate of inflation is usually stated as a percentage. An annual inflation rate of 2% means that a product that was priced at £1 last year will now be priced at £1.02. So, what is the impact of inflation on consumers? Inflation reduces the purchasing power of money since more money is now needed to buy the same items. High rates of inflation means that unless income increases at the same rate, people are worse off. This leads to lower levels of consumer spending and a fall in sales for businesses. The national minimum wage increased by 25% between 2010 and 2019 in this example. How does this compare to the percentage change in the price of crisps during the same period? Now, I just gave you a little flash beforehand about the working outs of this question. Quickly pause the video and try and work out what you believe the answer to be to this question. Now that I'm assuming you've worked it out and unpaused, let's go over the answer. So, percentage price change. In 2018, the price minus the 2010 price divided by the 2010 price again times 100. This is how you calculate percentage change, okay? So if we put that into the actual figures, that's 67 pence minus 45 pence divided by 45 pence times 100, okay? And then we have 04889 times 100, and this gives us our 49% price change. So since the price of crisps has increased at a faster pace than the national minimum wage, someone earning the national minimum wage between 2010 and 2019 has seen a reduction in their purchasing power for crisps. So, what is the impact of inflation on businesses? To compensate for inflation, staff may ask for pay rises above the rate of inflation. This would lead to higher costs for businesses and could result in prices being increased further, adding to inflation. This is what's called a wage price spiral, which, if you've been following the news recently, is what the government is very, very worried about right now, because we have the Network Rail strikes going on, and they are asking for pay rises equal to or above the rate of inflation, and the government is very, very worried about this. Okay, so inflation also affects global businesses that trade overseas. If inflation is higher in the UK than it is elsewhere, then the UK's goods become comparatively more expensive. This leads to a fall in the demand for the UK's goods. Now let's move on to government taxation, because this is very important. So, tax is a financial charge made by a government on individuals, consumers, and businesses. Government spending can influence the economic climate. However, governments have no money of their own. In order to spend money, a government must either borrow it or raise it from taxation. So let's go over the different types of taxes there are in the UK. There's income tax. This is a charge on income, such as wages that have been earned. There's corporation tax. This is a charge on a company's profits. There's national insurance contributions. These are charges to cover healthcare, state pensions, and employment-related benefits, such as job seekers' allowance. Both employers and employees pay this. Then there's a value-added tax, also known as VAT, which I'm sure you are familiar with. This is a charge on sales of goods and services based on the value of the item sold. It is collected by businesses, which then pass it on to the government, and this value is normally 20% of the cost of the product or service. Council tax is a charge on property by local councils based on the property's value and the number of people in a household. It is used to pay for local services such as refuse collection and street lighting. So, what is the impact of taxation on businesses? Either local or central government sets the amount of tax that must be paid. Some taxes, e.g. income tax, are paid directly to the government. Others, e.g. VAT, are collected on behalf of the government by businesses. The impact that taxation has on a business will depend whether the tax is paid directly to the government or indirectly through businesses. An increase in income tax means that workers have to pay more tax on their income. As a result, consumers have less money left over to spend on goods and services, and businesses expect to sell less, so we reduce the level of their investment. An increase in VAT will mean that consumers have to pay more for the goods and services this tax is charged on. This will mean consumers pay higher prices, which reduces their purchasing power, and inflation occurs, which affects businesses' costs. Changes in exchange rates. The exchange rate is the price of one currency expressed in terms of another currency. So, for example, £1 could equal 1.13 euros, or £1 could equal 1.20 US dollars. The value of a currency is determined by supply and demand. So, why are exchange rates important? Changes in exchange rates can affect the transportation and sale of goods or services imported into a country, as well the price of as goods exported abroad from the UK. Increasing globalization and improved technology have increased the number of businesses that buy and sell overseas, and all of these businesses are affected by changes in exchange rates. These businesses will need to consider exchange rates when agreeing prices. Otherwise, a good deal could quickly turn into a bad one if the exchange rate changes. Large and unexpected changes in exchange rates can create uncertainty for business that trade overseas. The impact of exchange rates. If the value of the pound increases, more foreign currency can be purchased for the same number of pounds. For example, if the value of the pound changes from £1 equals 120 US dollars to £1 equals 125 US dollars, then £100 would now convert to 125 US dollars instead of 120 US dollars. This is known as an appreciation in the value of the pound. A depreciation in the value of the pound would mean the opposite. So £1 for 120 US dollars to £1 to 110 US dollars. This would mean that less foreign currency can be obtained for the same amount of domestic currency. And remember, domestic means home, so your home country. So the pound has become weaker in this example. Changes in exchange rates can have a significant impact on the economy. A UK business that exports products will benefit from a fall in the value of the pound. Overseas firms will receive more UK pounds for their money, so they will pay less for the UK's products. However, the UK firms that import raw materials will have to spend more pounds to obtain the same foreign currency, so they will pay more for those raw materials. The effect of a change in exchange rates can be remembered using the acronyms SPICED and WPIDIC. SPICED means strong pounds makes imports cheaper but exports dearer, whereas WPIDIC means weak pound makes imports dearer but exports cheaper. And this is a very easy way to remember this relationship for exchange rates. And with that being said, guys, this is the end of today's lesson. I hope you learned all about the economy and how that affects business in today's lesson. Please do leave a like on the video, subscribe to the channel, and a comment in the comment sections if you have any questions that were not answered in this video. I'll be more than happy to answer your questions in the comments. And with that being said, guys, thank you very much for watching. Goodbye.